in Applied Corporate Finance, and we're going to look at the dividend policy of companies and discuss how the dividend itself is an important indicator of both the decision making of companies under corporate finance, as well as what investors and other stakeholders could expect out of a company's working, right? So we will have to understand what are the major measures of dividend, what are the key determinants of dividend policy, what are the various schools of thought on dividend policy, and how does a company really manage changes in the dividend policy? I mean, we'll also try and calculate how much should be the ideal dividend and how much is actually paid by the company. We will work on our standard companies in this analysis and try and understand uh, what changes to dividends those companies have done, understand whether they have paid enough dividend or not, and then case by case try and analyze if more dividend is good or not, right? So in terms of the first principles, we go back to our first idea that if you cannot find investments where you're going to make a minimum acceptable rate, then the money needs to be returned to your stockholders or investors, right? Now, how much cash you can return depends upon current and potential investment opportunities. So we have already looked at what kind of investment opportunities exist there and how can we minimize the cost of capital in order to go and take some of those investment opportunities. Now, assuming nothing is there, then dividend becomes an important mechanism. And depending on what kind of expectations people have, right, whether is going to come in terms of their preference for either a dividend or a buyback. We will explain those terms in more detail as we go along, but it's possible that sometimes stakeholders prefer dividends, sometimes they prefer buyback, sometimes they prefer some other modes of being returned cash, but it depends on a variety of factors which we are going to kind of consider as we go along, right? Let's first understand what is dividend. Now, when a firm makes profits, net profit on the P&L, it can choose to either retain those profits within the firm, and if they retain, they become source of funds. If those profits are retained, they go and sit under retained earnings or reserves and surplus on the balance sheet, correct? Or they could choose to return it to the equity holders. When the money is returned to the equity holders, that's known as a dividend. So eventually you could pay the money to the equity holder in the form of cash payments. This is known as a dividend. Dividend typically is a cash outflow, and hard cash is given to the equity holders of the firm. Thus, dividend policy becomes a very, very important part of the firm's corporate finance decision making. And investor preferences for a company may change based on its dividend policy, right? So whether a company pays more dividend, less dividend, high dividend, low dividend, zero dividend can shape exactly what investors expect out of it and may change investor preferences based on that, right? So let's also understand a few characteristics of dividends. Dividends, it has been seen that dividends tend to be sticky. What do we mean by sticky? It means that companies usually do not cut dividends, right? Companies usually would not cut dividends unless the financial situation is very bad. Why? Is because it sort of gives a signal that things are not in good shape if you cut the dividend. So dividends tend to be sticky. Firms are usually conservative in dividend payments, but once they start making dividend payments, you will usually find that they will not cut it. So the first thing we establish is dividends typically either remain stable or go up for most companies, right? For most companies, you will see either dividends stay stable or you will see dividends will go up. The second is that dividends tend to follow the earnings of a company. Now that's logical because technically dividends are being paid out from the earnings. So it's fairly straightforward to assume that dividends are going to follow the earnings. And as earnings keep going up, so do dividends for most firms, right? Dividends get impacted by taxation laws for dividends. Now, tax laws are important because the various ways a promoter or an equity holder can make money is either capital gains, right, which is the appreciation in the stock price, or via dividends. And you could also do what is called as a buyback. And if the tax treatment of